Mr. Chris Frostad. How are we, sir?
Very good. Thank you, Matt. Yourself?
All good here. All good. Raring to go. You look great in the black shirt. Is it the death of something, or
not yet?
Are you going to war, or have you just given up the clergy? What's going on?
Let's give it 10 minutes to see what.
let's do that then. I've spoken to a few people this week in the space, and there's a big conference on in Madrid, Spain. Tim Gitzel and many folk were up on stage, spouting off the usual mantras in the space, but which is all rather dull. But the one thing which I did come away with, which I thought was quite good, was a realization that supply is the issue. You and I have been banging on about that for a couple of months now, but it really is coming to a head, where generalist investors, the big banks, starting to realize that, well, maybe this isn't quite the data that we've been previously seeing or being led to believe. So, is that good news? Bad news? What are we going to do about it?
It's news that you and I have been talking about for a while now, is that it's, whether it's problems with the projections or what have you, it's quite evident to us that even if we don't add one more reactor, we've got a problem. And that problem keeps getting bigger and bigger every week. There's another geopolitical issue or mine issue or production issue. That number just keeps getting wider and wider. So I'm certainly reading a lot more about it, hearing a lot more about it. It seems to be the talk is that it's gotten away from, demand is on fire, and it's really all about supply. Supply is the challenge right now for sure.
Yeah. And I thought it was interesting because I was on I had a conversation with, Andre Lieberman, Yellowcake, who was there, and John Cash, who was not there. And neither of them think, in fact, I've spoken to enough CEOs, neither of them believe these sorts of production numbers, production profile, production numbers, timings, of both of those things are anywhere near what the companies claim. Because as John Cash can attest, mining and producing is pretty tough, and mining and producing economically is pretty tough. And Andre Lieberman, obviously, he's got a very nice deal with Kazatomprom, so perhaps he's less concerned. But they were both in violent agreement that it's going to be tough to kind of hit the numbers when we think the numbers are going to be hit, because people don't know really what they're doing. They're certainly not incentivized to do it, and they're not getting funding. And it's subject dear to your heart, I'm sure.
Well, because none of these companies are giving you their worst case scenarios. Yeah. Why would they? Especially in these markets when it's tough all around. Like everybody's putting their best foot forward, and so you're getting an overly optimistic view of what can happen. And the problem is that those institutions that are putting these numbers together are actually taking them as gospel and publishing them out that way. And we can see that none of those underlying numbers are actually making the cut.
Right. And what about you in terms of the capital markets? So I guess that's the end of the last question. What's happening out there? I'm not seeing a lot happening.
No, well, and we were talking about that. I mean, I think the markets, they've heard the story so many times and so often for so long, and we continue to see, the overall markets, when you put everything together, so somewhat languishing. So it's getting to be tiresome, I think, for a lot of investors, who are questioning whether it's actually coming or not. And so that's certainly been an issue overall. In terms of raising money, we've said, before that it's been, we can raise money, but it's not at attractive prices by any means. And I think the last few months, it's become even harder to raise money. So we've seen a number of financings come out of the gate, and really have to be revisited, rejigged, revamped in terms of how they're being structured or priced, what kind of money's going into it. So I think it's getting tougher now just to get the money that's necessary to do the work we're supposed to be doing out there in the field. As we've talked about before, I mean, right now we're in a decent space because, the projects that we're working on this year, all of the projects we're working on this year, we have partners on. So we're sharing costs in that regard, and we're earning back fees as part of that, as the operator, which also moves things along. So we're we're not as reliant on doing massive raises every once in a while. But we're in the same boat. We do have to raise our share of these exploration costs, and it's tight right now. And a lot of that's being caused, obviously, by a lot of the politics coming out of the U.S. and the uncertainty. So, with the uncertainty, everyone sits on their hands for a while and waits for the dust to settle.
Well, look, I guess there's a bit of good news out of the Middle East. And Trump's just done a sort of whirlwind tour over there. Seems to have signed a number of big deals. Lots of tariff-type conversations, negotiations, renegotiations happening. And that might settle the market somewhat. And I know it's an ex-banker that's exactly what we want to see. We want to understand what the rules are so we can actually work out how to design and create products which will work. So we shall see what happens there, and hopefully you guys become friends again.
Well, I think we'll be okay. We'll be okay. But the news that came out of their conversations with China last weekend helped the markets a lot, I think, as well. So things are settling down. There's a little more visibility, and the markets are reacting positively in that regard. So hopefully this is all a bit of a temporal situation. But I think we're heading in a better place right now.
You might be able to go on holiday there again soon. Who knows? Who knows? I was with one CEO last night. I won't say his name, but they usually head down to the US, and I think that they're heading off to Greece for 2 weeks. So well done, welcome to Europe.
Well, I think most Canadians have been put off holidaying in the States for a little while, and it's showing up down there.
You guys are pissed.
Well, but quietly. Yeah, we're more passive aggressively pissed, right? So we just won't show up. Yeah. We won't yell and scream. We'll just not mean we'll
see more uranium people coming back to Twitter or X, because they disappeared off to, was it blue something or other? What's it called? Hey Tom, what's that blue thing called?
Blue Sky.
Blue Sky. I think lots of people have come back from Blue Sky. Made friends again. Right. Okay. Look, this is probably kind of part 3 of a kind of series that we're doing on trying to understand the trials and tribulations of being a junior exploration uranium company, the things that we need to be aware of as investors to look out for, kind of read between the lines, and also how to interpret things. And so today, folks, we're going to talk about, we've talked in the past about jurisdiction, but we're going to talk very specifically about the kind of the land which the company owns, and how to own it, how long to own it for, etc., etc. And I think things like kind of capital structure and the kind of setup there, because that's super important. Whatever, it doesn't need to be uranium company, needs to be, it just needs to be set up properly. It can also show, I think, some clues in there. It shows the intent of the company. Some really good clues that we kind of look for. We'll get into maybe a little bit of how to interpret how companies actually spend money on the ground. The type of spend is kind of important. It's probably a reflection of the stage they're at, etc. But also, I think, as a reflection of the kind of intent and the kind of the model that they're employing, and how they're going to move forward into a kind of resource estimate phase or not. And I guess maybe they'll help us understand how they're telling a story and why they're telling it like that. That's probably enough. There's a bunch more which we'll pick up again on next week, but for now, that's where we're going on this session, folks. So I guess for you, Chris, let's talk about land. There's things like how they own the land, how do they control the land. Let's start with that. I mean, what do you recommend?
Well, I think, and again, the uranium space we're talking about is somewhat, it's a small space, and so it's it has to be viewed through that lens. Most of the public companies we're talking about are in exploration. There's only a handful of companies globally that are actually producing uranium right now, and those that are developing them are doing their best to come out the other end. But when we look at exploration, 95% of it is all greenfield exploration, which is why a lot of it happens, I think, in Saskatchewan, because your odds are better there. And so, does it matter whether we own 100% of it, or at what point in time do you not? I'm not sure. I think, well, we've got our own views on that. In terms of earn-ins and things like your project generator model, it makes sense. I mean, in this industry, it's always earn-ins have always made sense because it's the way to get the money in the ground on a project that you really can't value yet. I mean, let's face it. I think royalties were invented specifically for this reason and for this industry. When you're trying to buy or sell a piece of property that you really couldn't value yet because there might be something there. So how do I sell you something that may be worth billions down the road without giving it all away? And you do that by hanging on to a royalty that may or may not someday pay off in case you shouldn't have sold it off. But it's so the whole earn-in thing has been a real staple of getting partners to pick up and put money in the ground, which is what we're all looking for right now. So, whether, in our case, we put in the deal we did with ISO, we took projects that we owned 100% on. They took projects that they owned 100% on, and we put them into one great big joint venture. So we each own 50% of the whole thing. So the question is, in a situation where most juniors find nothing, and all we're trying to do really is improve the odds of making a discovery, what's better, to own 50% of or 100% of something, or reduce your ownership by 50% and double the odds of finding something, because we've just doubled our land package and we've increased and improved the cost of exploring it. Because at the end of the day, we are, as explorers, the biggest kick we get, probably the biggest kick in the entire cycle, is on discovery. And so, we're not, when you're looking at the percentage ownership, if I discover something, does it really matter whether I own 20% of it or 50% of it or 100% of it? Yeah, I guess so. It's going to be valued that way, but the odds of finding it, if you can improve the odds of finding it at all, you're going to get the uptick you're looking for from a value standpoint, even if you own a smaller percentage of it. That's our view, anyways.
Okay, there's a few things there, and I think it's worth kind of delving, because the nuance is important and the detail is important, because it can help make companies come unstuck later. So let's talk about a few of the things you mentioned there. Let's talk about the difference between owning ownership of mineral rights versus surface rights. I've seen a few companies come stuck because they can't actually access their property in a way that they want to, or when they want to. And I think one deal I was offered recently, I think the local farmer had basically planted a whole forest of trees to make sure that the company had no actual surface access. So that's something you need to think about, isn't it?
I think Canada is interesting in that regard. In that when the rules of engagement for mining were first set in place, it was recognized how important resources were to Canada, and they were given quite a lot of leeway in terms of what they can do. So if I have the mineral rights, if somebody else has the mineral rights to my house here, they can actually drag a drill into my backyard and I can't stop them, even if they don't have, what we call surface rights. That's Canada. Now, is it practical? Well, no. And that's how we get into issues with the local communities and with First Nations up north, or when we're in isolated places, it's not as big a deal. But I know that in some areas of Canada, when you buy your house, it's very common to also acquire the mineral rights to make sure that you own everything underneath it, or that nobody else can grab it and do what I just mentioned. And so there are areas around Ontario and around different provinces where a lot of these mineral rights have been chopped up so tightly that no one can actually own enough of it to do anything with it. But it's not that big an issue in Canada for mining companies.
Try Spain, try Chile. I've looked at projects in this part of the world, and obviously invested in stuff, and suddenly you sit in bits of Africa and you suddenly realize these guys didn't think of everything. They do not have the type of access that they need. Don't have the water rights and forestry permits, etc. They don't have those things in place. can they get them? I don't know. So, I mean, the funny one in Chile recently was literally, it was a deal that should be, I've just done a Chilean deal and looking at picking up more deals. And so this thing was offered to me. And, that was one of the questions, quite far down my list, but nevertheless, it was one of the questions, which was right. How do I get there? We're just getting around that at the moment. We're negotiating with the local farmer who's planted a whole bunch of, I don't know what the type of trees were, but, a lot of them, which means that he's not just using that in terms of blocking access, but in terms of the company's ability to actually remove those trees. So all sorts of time sensitive activity, which is, the longer this goes on, the more money the company burns, and the harder it is for them to actually be around to do anything about it, or that will get stuck in some kind of litigation, etc. So the whole thing becomes very, very messy. So little things like that matter, is what I'm saying. So
I mean, the scariest people we deal with here in Canada is the Department of Oceans and Fisheries, because they can do anything. Like they've got scary power. If you're standing on the end of a dock fishing, and it's not fishing season, they can seize your boat. They can seize your house. They can seize your car. They think it's crazy. And so they're the ones actually that we really watch, because they're, it's protecting wildlife, and in particular, the water and the habitat and that sort of stuff. They're probably the scariest outfit that we have to deal with from time to time. Right. Sure we're never offside with.
Yeah, we're going through a bit of that with fisheries over here at the moment. So it seems to be giving it away to Europe. It's been 0.5% of our economy, but we seem to be giving it away as a negotiation tactic to get back into Europe, it seems. Right. You mentioned royalties in there. I've seen scenarios where the royalties on companies are so big that it makes it prohibitive, or for companies to come in and say, well, I will buy you, because they would be mining for free. Not mine for free. They would not be making any money if they started to mine this thing. What's the kind of ideal setup there? From people who've kind of been a bit greedy at the beginning, it's going to block any potential exit at the end.
I think royalties are again, they're the kind of thing that are hanging off everything, and it was originally invented so that I could sell you something for $100,000 and not feel like a mook 10 years later or 5 years later when it's worth $1 billion. And it was actually Franco-Nevada that decided that, if we put all these things together, we've got a cash flow coming out of it. And they invented the whole notion of turning that into a business. In general, I mean, when you're looking at royalties, what was once sent to me, and it made a lot of sense, if your project cannot withstand a 2% royalty or a 4% royalty, then you probably shouldn't be building it, because commodity prices move far greater than that from one day to the next. There's that aspect to it. But there is a lot of, and particularly in uranium, in the U.S., the Department of Energy, all the property that they own, all the projects that they hold have got ridiculous royalties on them, like 11%, 15%, 20%. And when you layer on top of that other royalties other people have come, these projects are just they're unworkable. It's impossible. So it can pile up. But I mean, I've never looked at a small royalty as being, small being anything less, 4% or less as being prohibitive to advancing a project.
4%, really?
Well,
man, I struggle with 2, and I prefer,
it depends on the commodity, right? It depends on the commodity, and again, it's all the price, because it's coming off the top, right?
Well, yeah, but your margins get really squeezed. The top of what? I guess it comes down to the type of royalty, but it's also things like back-end rights as well. It's kind of like or significant shareholders. Where if someone's sitting on 19.9%, can you get any competitive tension?
That's a different challenge, and that's a different problem. And we have seen
back-end rights then.
We've seen a lot of deals done in the basin too, where there are these back-end rights that, they're untenable. If I find something, all the value, they can buy all the value back out of it. We've gotten into conversations with some of the larger companies there on some projects we were looking to work on, and the back end, the ability for them to buy back in their share was, it just economically didn't work for anybody. It wasn't worth making the investment. So those, I think, people have to watch for, because they're not always talked about too loudly, right? It's the kind of term that you hide necessarily. If you're an exploration company and you've done some big deal to acquire what looks to be a fabulous project, number one bullet isn't, oh yes, and these guys can buy it back if we find anything for $2 million. So you do have to watch that, because there's a number of projects out there right now that are riding with that sort of term sitting in their agreement.
Yep, mine included. We want to be able to buy back 1% of the royalty we have on it.
Well, that's buying back a royalty, right? That's different. That I see. I mean, that's fine. You can buy back some of the royalty. That's pretty common. But I'm talking about being able to buy back, ownership in the project.
Sorry, so you're still talking about back end, right? Okay, got it. Yeah. Okay. What are the other things that we need to think about when we think of land? In terms of maybe how you've acquired the land. If you haven't staked or pegged it yourself, do you have option payments? Are you paying with cash or shares? When? How often?
A lot of the earn-in deals we do see also involve cutting a check to the whoever has this property, who you're optioning it from. Does involve, cutting a check, cutting shares, issuing shares, and you have to watch and see how that's been done. Is it a dollar value of shares, or is it just a blanket number of shares? And in some cases, the cash payment to the original owner is not a small percentage of the money that's being required to put in the ground. So of course, all of these deals, the more money that's focused on putting it in the ground, it means the more serious, I guess, the optionor is that the project has value and that you're actually going to find something. If I'm just getting rid of something I'm tired of, then I want to get as much out of it as I can up front, because I really don't think you're going to find anything. So that becomes quite evident when you look through some of these deals as well. The other thing is literally control. Who's doing the work? So in many cases, the person optioning the project off is actually doing the work for the person who's earning in, because they might not have a team in place there, or that might make sense. And what are some of the other things that come up in those deals?
What about, okay, whilst you're thinking and contemplating.
Sorry, turn out here.
Yeah. Okay. Yeah, okay. Onset Alzheimer's happening for both of us. No, the other thing is in terms of whatever that kind of structure and those option payments look like, or share payments look like. I'm sort of intrigued by the sort of structure of those deals in terms of not only sort of the schedule of payments and whether you can afford to do it. If it's issuing shares, I guess it makes it a little bit less painful, but if it's issuing cash, it's kind of problematic. So there comes a point at which you say, actually, no, thank you very much. If I don't want to continue I don't want to pay anymore. What's the kind of ideal timeline to kind of lay out to give you a chance of actually finding something, and more importantly, reduce your kind of
the timelines are important, because sometimes, I mean, the worst case scenario is where I said, okay, I'm optioning this property off. You've got 5 years to spend, pick a number, $5 million, and that's it. Well, that means you can park this project for 5 years and then just give it back to me and not spend a dime on it. And those are situations that you have to watch when you're dealing with some of the larger majors, because they don't, and it's because they don't want to be stuck into a schedule or timeline, because they change their mind on a whim. So, where you've got structure around money going in the ground, year 1, year 2, year 3, year 4, that's very useful and very helpful. And you want to see that happening, so that the money has to, it's not going to sit for a while, waiting for something waiting for them to go find the money to actually do the work they're supposed to be doing. The other thing is who controls, who is the decision making in a lot of this stuff. And again, I'll go back to our transaction with ISO, and from a joint venture standpoint, is, a lot of time and effort went into crafting the rules of engagement. Who makes the decision? What if there's a disagreement? I mean, we're a 50-50, so it's there are situations where if we don't agree, we've got to figure out how to break that tie, if you will. And so there a lot of thought and governors kind of went into those guardrails as to how indecision like that or disagreements don't stop everything. But in other situations, such as our situation with Cameco and or Orano, I mean, we are a minority partner. And so in that case, they control the budgets from year to year. And it's our job to put forward the best case we can to outline what we think should be spent and where it should be spent. And the onus is on us. I guess that keeps us honest in that regard.
Well, okay. Well, talking of which, and I think we did touch this conversation last week, which, I have my views, strong views, on this one, which is like, how do we as investors verify the work commitments from financings are actually being spent on exploration and not other more fancy things not related to
Are you talking to partnerships in particular?
Okay. I guess there's two things to it. So yeah, one in terms of partnerships, I guess with your partners, they want to know, well, you're spending the money in the ground, we're paying a management fee. I darn well hope so. And then for me as an investor, looking into the company and going, is the money being spent where you've told me it's going to be spent?
Well, the partner one is it's easy in that we have a formal process of making decisions and of putting together plans, budgets, and then executing on that work. So it's easy for us in those situations in any partnership to be able to discuss that, and we want to make sure that's the information we're putting out in the world and that they're doing. And I think that's generally the case. Even with earn-ins, if the situation is they have somebody's earning in on a project and they have to spend so much money each year, that's pretty regularly reported by both parties in that case. Because again, as a junior explorer, you want as much news out there as humanly possible. So nobody's sitting on that kind of information. It's out there. It's out there to be seen. Now, if all I'm doing is working on all my own 100% owned projects, I'm raising money. It has to be spent. Then you've got you got to keep an eye on whether they're telling you what they're going to do, whether they're telling you when they're doing it, whether they're telling you they're done doing it. Like all of those things should be coming out on a regular basis, and you as an investor should be able to track that. And if they're going quiet on situations for long periods of time, then that's concerning.
Well, I can sort of track it because that's kind of, like I say, soft, fluffy stuff. I can, are the press releases coming out? Are they actually telling us what they're doing? I'm talking about, because again, I guess this could split into two. It's kind of like if you do kind of charity flow through, you've got to spend your money in the ground, right? Versus hard dollars.
Right.
But, outside of it, even if it was hard dollars, which you've raised from shareholders, and you've said, we are going to spend X% of this in the ground. How do we know you have? And it doesn't mean, like I said, spent on an exorbitant, trips to somewhere else, got nothing to do with the drilling.
This is really your pet peeve, isn't it, Matt?
It is my pet peeve because I see far too much of it, and I've seen enough of it this week, quite frankly, at 1-to-1. So, it gets on my. And
I haven't got a good answer for you because again, you're talking about amounts that are being spent probably inappropriately, probably by individuals for their own individual benefit or pleasure or what have you. But those numbers in and of themselves aren't itemized anywhere for you to see. I know,
but we have the same thing. It's indicative of a behavior and an attitude to we're aligned with shareholders. It's like, please do me a favor. You are not. This is
it's how well things are being spent. So if I look at everybody and I know, okay, your average junior out there is spending $2 million a year on overhead. I'm just pulling the number up, and I can look and I can see that $800,000 of that is audits and news releases and all the stuff that we have to do to be public, and then I see that how much is compensation, and then I see what's the rest. So if everybody's spending on average, I don't know, $500,000 a year on communications, that's about as much of information as you're going to get, because now you've got to determine whether they're spending it appropriately. whether they're spending it in a way that you would spend it. Are they going to conferences, or are they hiring big IR firms, or are they, how are they spending it? You're getting into the minutia of how they spend, when in fact the information you only really have available to you is more of a macro basis, is those large numbers on a P&L, and do they look right? I don't know how to help you, Matt, in terms of
I think I just
swarming these conferences and telling people to put your wallet away. Yeah.
Well, yeah. I know it is a bugbear, but it's like, I guess I don't want to be treated as some sort of mug, and I'm focused on the little things. The little things matter because it all adds up.
But you're also in the front line of fire to see that kind of stuff. Investors generally aren't. You're going to conferences and things that investors don't generally go to.
Yeah,
by and large, you're certainly not your retail crowd. They're not seeing what you're seeing. Because you're a guy that likes to get wined and dined, and people like to wine and dine you. So
wined and dined me? Are you kidding me? I don't think there's a bill I haven't paid. I'm not even going to say. What some CEO asked me to do this week. Yeah, right. You were dressed in black like a priest, and I think I should be wearing a sort of like a red cardinal's outfit. Like
to get that upper status on
Roman Curia. No. It's just they are the church's governance.
Oh, I see.
Yeah, and deal with the election of the.
It's not the Inquisition here.
Less relevant.
Yeah.
The election of the CEOs. That's what I want. The right guys doing the right things. Okay. Well, fine. We won't ever agree on that one. But I feel that.
Well, I don't disagree with.
I think it'd be better if they.
I don't disagree with your issue. I just don't know how, as an investor, you really get a good handle on that.
Oh, yeah, I don't think you do, and I just wonder if the exchange, do ask for a little bit more line item than the current reporting. That would be interesting to me. Break down the type of spend. It's just like big, broad categories of G&A.
But it's not just happening in resource companies. I mean, come on.
True. No, that's true. But we are talking about resource today, so I'm focused on that one for sure. Absolutely. Okay. Well, let's kind of move on. I talked about kind of charity flow through and flow through. Do you prefer that they kind of overspend their minimum flow through, or kind of work to commitment obligations, or how do you think people should be raising that money, and if they should be raising? Because I've heard CEOs say to me, I regret doing charity flow through because there's a game played out there, which kind of struggle with.
There's a lot of pieces to it, right? So first of all, whatever you raise, you have a limited amount of time to spend. So whatever I raise
typically
this year, well, it's the rule is 2 years, but it gets shortened if I renounce my expenses earlier. So essentially, which they always do. So whatever I raise this year in the calendar year has to be spent by the end of the next calendar year. That's your general rule. So you do know that there's a limit. And of course, if I raise, so if I raise something in December, I really only have 12 months to spend it. If I raise something in January, I've got 2 years to spend it. And if I raise too much of it, I got to spend it. I know when the program first came out, there were some crazy things going on. I'm going back a long time, but I mean, it'd be coming up to the end of the year. The flow through hadn't been spent. And if it doesn't get spent, it's a company killer, because you've got to go back to all the people that you raise that money from and tell them that they don't get that deduction anymore that they took last year or what have you. And so, there's been crazy stories about, a fleet of helicopters just floating in the air, burning gas in order to get the money spent before the end of the year, because it would have been devastating otherwise. So, you can raise too much of that stuff if you don't have, solid plan to spend it. The other things you worry about too is if it's just traditional flow through, your normal flow through, you're typically spending it with flow through funds, or getting it through funds who are making their money on that spread, right? Because they're bringing in money from investors. They're giving out a tax deduction. They're probably buying these shares at a bit of a premium, but when the dust settles, they've made a lot of money on those shares and they can sell them at a loss. And the typical rule, and there's a lot of exceptions to all this, but your flow through shares especially if there's a warrant attached to them, are all going to hit the market after the 4 month after the 4 months is over. There's a 4-month hold typically on these financings. So a fund will, give you $1 million. 4 months later, they will flush all of those shares back out on the market on you. That's a challenge. Charity's a little different because, in fact, the flow-through fund doesn't wind up holding the shares at the end of the transaction. An investor does who paid hard dollars at a discount to hold those shares. So if I'm trading for $1, the charity flow through fund may buy shares from me for $1.50. And then the tax advantages all get scraped off. It's donated to a charity who immediately sells it to a back end buyer for 90 cents. So there's a lot of planets you have to line up. The difference here is that you're selling to somebody who's paying hard dollars for it, right? So it's not like a flow through fund that's got to get rid of this stuff anymore. You've got somebody who's actually, paid the share. So, you're less likely to see those shares coming right back at you on the open market.
Right.
If you've got solid investors playing that back end. Yeah. And there's an if, and there's other nuances to it as well. If there's a warrant attached to it.
Right. Isn't that the game though? Explain the game that's
the game is, okay, so I'm the shares trading for $1. I just bought it for 90 cents with a warrant at $1.20. So as soon as I can, I sell my share, get my 90 cents back, and I just sit on a free warrant. That's the game. Now, the 4-month hold that is typically associated with these transactions is to kind of prevent that. So I got to sit on this for a while. So, I'm not necessarily going to be able to dump it out on the next day. But again, in Canada, there's an exception called the life exception, which if it's 5 million or less, the company could in fact issue those shares without a hold. And that becomes a problem if you've attached a warrant to it. Because now all of a sudden I'm going to buy it for 90 cents, sell it tomorrow for 90 cents and hang on to my free option. And you've just had all these shares, hit you in the forehead.
What's the wrong type of investor at that point, right? That's not who you want in it. And that's the complaint that we get a lot.
So the company has to be careful as to who they're dealing with. And we've dealt with funds that haven't sold us off and they've been very good for years. And we you find these people you can work with, or if they know things they're going to sell off, they'll call you ahead of time, say, look, I'm getting to the end of my fund. I have to monetize this stuff. And and we can all work together to find buyers for some of that stuff. So the company needs to be managing those bigger sales and they're investors to the extent that they can.
Hey, but to use a catchphrase of mine, and I've got a t-shirt, desperate people do desperate things. Sometimes the companies are not in a position to kind of question the type of money that they put in.
And exploration companies, by definition, are desperate.
Are desperate. If I get an extra 30% of cash, of course I'm gonna go for that thing, knowing that maybe my stock's going to be dumped and people are going to be playing the warrant game, and maybe I've got the wrong type of shareholder profile, and maybe they are a bit more patient, and I become under a lot more pressure. So there's a lot of things, but the expectation is that the money they spend will kind of create value, and there's been no guarantee of that. Certainly not for the last 5 years I've been in the kind of Canadian junior space. No guarantees that that's going to happen. So that's been the big problem here, and I think some swings that companies, we see as with deep regrets of having gone down that route, unless they've been in a position to carefully manage who those shareholders are. But anyway, so that's one to watch out for, folks, for sure. I guess before I completely leave my pet peeve, in terms of companies publishing sort of quarterly or sort of semi-annual, result. No, say it's quarterly, isn't it? Quarterly results. Do you think that they should do the same thing for, in terms of exploration and G&A spend, in terms of the breakdowns, even if it's as wild and vague as they're currently allowed to get away with? Would that lend more credibility to the sector, more accountability to companies?
If they're breaking down, generally your quarterly statements are not much different than in Canada. They're normal financial statements like your annual one. The only difference is your annual one's audited. And if the company, like for a couple of years, we had a shelf prospectus, which required us to get a review every quarter as well, so that we're being looked at by our auditors on a quarterly basis. But I mean, the disclosure requirements are the same in Canada from a financial statement standpoint.
Okay.
You just want somebody to force a line item that says liquor, conferences, meals over $100.
But just a real, yeah, I kind of do. I kind of want, I know as a percentage of G&A, some of this personal benefit stuff.
And there could be a better definition of what goes out there, because some financial statements, you look at the P&L and it's got exploration, G&A, bottom line. And then in others, I mean, ours, we have a whole litany of things. So we're breaking out, we've maybe got 12 different categories, but there's no requirement one way or the other necessarily as to how much you break down. I would say that most P&Ls in our group of peers are breaking it down to at least 6, 7, 8 categories.
Okay. I promise I'll get off of it. Oh, it was just standardized. In terms of the kind of the ratio of exploration spend to corporate spend and or any other kind of spend, I mean, what percentage of the money raised should you think go in the ground?
Well, they say it's kind of 10% should be your overhead, but I don't think those rules of thumb work for us here. Because first of all, you should be trying not to spend hard dollars in the ground in Canada. Like, I'm just talking in Canada here, because they're hard to get, and you buy them you issue them at a discount. So when you've got hard dollars in your pocket, you're hanging on to it like grim death. You should be using your flow through opportunities to put money in the ground. And as I've said before, the cost of running a public company for a junior is pretty static. It's going to be up and down or whatever. So you're going to generally have your cost of being public, all your exchange fees and audits and lawyers and AGM fees and all that kind of stuff. You're going to have some compensation. You're probably going to maybe have an office and communications, and that's the breakdown. So it's not going to vary from company to company. I mean, our overhead should not be any different than Sky Harbor's or Canalaska's or whoever. I mean, you pick them up. You should be able to compare them, because it shouldn't be affected by how much money you're putting in the ground. If I haven't got money to put in the ground this year, but I still have to keep an office, I still have to be a public company, then, my overhead might be 90% of my overall burn. So I don't, but I've seen companies that are, in my mind, really blowing the doors off from an overhead perspective. Keep going back to that and going, well, it's 10% of our overall spend. So 90% is going in the ground as the justification for, living it up, on the overhead side. So yeah, I don't know if I've answered your question, but I really don't think it's a percentage. I necessarily.
You don't, case by case, but this percentage wise, it's got to be within a sort of range there, hasn't it? You've got to be sort of,
well, it does. If you're hanging on for, I mean, look at it this way. When uranium was languishing like crazy, we were relying quite heavily on Hook Lake, on our joint venture with Cameco and Orano. So our burn rate, we got down as low as possible to keep the doors open, keep the lights on. It was probably, $600,000 to $1 million a year. But as a percentage of our spend in the ground, it was our spend was low because we were putting much more money in the ground. Right. So for every $100,000 we were spending, there was actually $1 million going in the ground. So it's you can hold up your thumb and say it should be this, that, or the other thing, but you got to take a little bit more time to look under the covers and figure out what it should or shouldn't be. But I don't think it should be that hard.
Okay, I agree. I agree with you. And look, I think I'm going to come up with the last topic now, which is really around sort of capital structure. And next week, I think we're going to talk about kind of path to resource estimate, and our company's using the right people. Why the name of the consultant is really important. The track record, etc. We'll talk about things like infrastructure proximity, and I've got some good stories about that. And a kind of clear inarticulate exit strategy, and then obviously timing the market, which is a great one for investors. So let's just finish off on a kind of capital structure, okay? And here's one which we the good and the bad get accused of this, and in equal measure, because some investors like to see a large level of ownership by the management. So insider ownership levels, alignment with shareholders. I mentioned it earlier. It matters so much to some people, but in a lot of, I've seen instances where the management team have no shares. They've not bought in the open market, and they don't have any alignment with shareholders. And there might be one of 4 or 5 jobs that they have, and I can see why that's extremely frustrating. But in some, there's always extreme cases why the management have not bought stock. The CEO may be broke. He may have had a big tax bill. He may have got divorced. He may have a sick child at home. And all of those things are true. I've met all of people. Well,
and you can look at how many junior companies out there have you seen where, in fact, they're not getting paid at all. They're just accruing salaries, which is really a bit of a death spiral. Really, but it's most of these companies don't do well. Let's face it, right? I mean, exploration is exploration, and maybe investors want to view it as though they're looking at an entrepreneurial situation here, right? Where the owner owns the lion's share of the shares, and they've kind of let somebody else in on the rest. And depending on the situation, that's not necessarily reasonable, expectation of a public company, especially over time, and especially in companies where that have been around and have had to raise a lot of money. Exploration does that. We raise a lot of money over time. Your original ownership percentage goes down and down and down, just with pure dilution over time. It's hard to really understand and visualize what their expectation is when they're looking at, a small junior exploration company and what they expect the share capital or the capital structure to be. Because when I was in the venture capital business, right, you always wanted to make sure that the owner was aligned by, never grinding them down to 10% or 20%, right? If they come in, you don't want to buy 60% of that company. You want to buy 10 or 20. You don't want to grind them down because you want them to be, aligned, if you will. That's not a reasonable expectation with a public company, particularly one that is not revenue generating. And that's not the game. And that has to continuously raise money and put shares out in investors' hands over time.
Yeah, I was going to say, like, it's a kind of moving feast, and like I said, I've seen lots of scenarios where people would want to, but can't. They just don't have the disposable income, to be able to do so. And you think, well, they're being paid a lot of money. So, well, they kind of are in some cases, and not in a lot of others, And I do like a CEO who doesn't take a salary, but I think it's unrealistic to do that. But that's what it comes back to, this kind of behavior and that kind of whole expenses thing. It's like, have they got some dignity? Have they got some? They have conservatism about them. Do they have, I guess, that honesty? Quite frankly, in terms of attitude to shareholders' money, it's shareholder, saying, we're careful stewards of shareholders' money, and then their behavior is like, well, I kind of brought my wife along, flight paid for by the company, or we're going to go on a week's holiday afterwards paid for by the company. We're going to really nice restaurants paid for. It's like that's kind of what I mean when I say I need to understand that the makeup of the person, they're
you're going back to the conferences.
I am, but this is exactly why, So if you go, I am a steward of shareholders' money.
So you can look at, and I've done alignment. I've done
this. You've got to be aligned.
Right.
It's not your money.
I've talked about it is not your money. You're right. You're absolutely right. And I've gone back and looked at, and I'm not going to spout out numbers here, but if you go back and one of the easiest things to do is look up what everybody's getting paid, right? And how many shares they've got and how many options they're sitting on, and et cetera. And if you look at in our space, if you look at the uranium space, you look across the amount of juniors, you'll find that everybody's getting paid about the same amount. And it's pretty easy to find those men or women that for some reason are making 2 or 3 times what their peer group seems to be, and for no good reason. And you'd also find that it's not a vast amount of money. These are people that are generally getting paid a normal salary. Not nothing outrageous. You can pick out the outrageous people pretty easily. So I mean, you shouldn't be taking holidays on the company dime and taking the family along for weeks and go watching the gorillas and all that kind of stuff. Absolutely not, because that's not your money. That's not your money. And the board and we've had the conversation about, the usefulness of the boards in this situation, but that is their job too. I mean, is to be keeping an eye on that sort of stuff. Many times we've gone through various aspects of governance over the years, but the board would have to sign off on my credit card bill every month, or any checks that were made out to me personally had to be there. So, there's simple things that can be put in place by the board to keep an eye on that kind of stuff, and they should be doing it. Again, we've had the conversation. They're not always, because they're all, brother-in-laws and pals on 5 other boards, and they're going on the same holiday with them or something. But, but that, the guardrails are defined. They may just not always be policed or upheld.
Yeah, I think audit committees, and unless it's a big company, audit committees and remuneration committees are a joke. It's run by the CEO. Yes, the bigger the company gets, the harder that is, for sure. And it's like in my case, having sort of got some exposure to kind of TSX, recently with the copper deal. So I put in $2.5 million private, could have lost it. Turns out it looks like it might be something valuable. Lots of offers on the table. I took the lowest offer on the table because I like the people. I trusted the people. I think they are good stewards of investors' money, right? I think I like that. I've been offered a board seat. I'm not going to take that. I'm certainly not asking to be paid for it. It's ridiculous thing, for it to happen. So I just wish there's a bit more of that, quite frankly, in the space. But
like I say, I mean, there is, we're seeing in Canada on the exchanges, we are seeing some attempt to tighten up on that in terms of requirement to become a board member of a public company. It's not just, your son-in-law or your grandmother. You have to have some credentials behind you. But I mean, there's only so much they're going to do.
Yeah, I know. Okay. Right. Obviously with the kind of small juniors, it's predominantly retail. Everyone wants to try and talk a game of getting institutional support, but in uranium, that's tough because there's not a lot of institutions looking at the space at the moment. I think it's growing, but based on what, we're showing full loop to the conversation at the beginning about this conference in Spain, this week, just gone, Monday, Tuesday. It's coming, but right now for small juniors in the space, retails, it's unrealistic. So they need retail to come back, and they need retail to understand, but they need to be patient. Would you agree? Oh,
for sure. But we've been asking for that patience for a while now. So, but be a little bit more patient because it's coming. We know it's coming, but it's going to take some time. Yeah. I'll wear my collar next week. Yeah.
I know, just an A4 sheet of paper, just wrap it around that. I think you might get a different audience. A lot of money. Midwest. Just think about it. And you can, and when your kids get married, you can like perform the rites, or not the rites. What's it called?
If it saves me $1, I'll do it. Yeah.
Oh, do it just for fun. What about okay, another one. It sounds like I'm beating up a management team, but they deserve it. It's fine. Performance warrants. How do you create a structure which deals with performance warrants tied to expiration milestones?
We haven't done that yet, and we're looking at it right now because there's a lot of different tax consequences to it. And so we're actually right now going through that notion of maybe moving, particularly our board, from option compensation to performance share units. But again, it comes with a lot of funny tax consequences that we don't want to trigger. Options can be handed out without any performance criteria, whereas your RSUs need to have some sort of future performance trigger, but they can be as heavy or light as you want. So I think counting on them as a motivator is probably not a wise thing for an investor. Let's keep everybody honest, because I don't think
one gold guy, Aussie gold guy. The project was in Chile. I don't think people can work out who it is. They set themselves in performance warrants, and which is based on, I think, deliverable of a resource, right? But the resource, they've been, I think, slightly hampered by COVID and supply chain issues, etc. But the time was coming up whereby they needed to present a resource, so they put out a resource at the right time, but it was half the size that it had been indicated at. So the markets rewarded them with a 50%, I think, ultimately an 80% drop in share price. So that's one that backfired.
Yeah, how those warrants work out for you? Yeah.
But it allowed them to pay themselves back some of the money they'd put into the company, which is again extraordinary, selfish, non-aligned with shareholders.
There's a lot of moving parts in some of these things. It's not as simple as people want to think. For the positive or the negative,
Yeah, but the point is, you look for them. If there are performance warrants or performance bonuses, you gotta understand what they are and what it could do to the company if the company.
Well, what actions it may motivate management to take that aren't necessarily aligned, so to speak.
Show me the incentive, I'll show you the outcome. People are predictable, if nothing else. Okay, and then I guess the last thing on this is, and again, I think we've talked about it a little bit in the past, which is kind of in terms of the kind of capital structure and the kind of setup, and these are the things that give you clues about the company's intent, which is basically legacy cheap paper, right? So I've had lots of brokers come to me and say, look, hey, for $200, we can set up a shell, clean shell, and we just need to find some asset to roll into it, and we can set ourselves up like 0.5 cent, 1 cent stock, load up. All we need to do is get 200 additional shareholders. They'll come in at 5 cents, and they're in on the deal too. So you got 205 people, presumably, who will have super, super cheap stock, just need to find the right asset and pump the shit out of it. And off we go, boys and girls. I've never done it. I don't want to do it. I just think you look like a douchebag if you do that, right? So that's
no, we haven't. I haven't done that. I haven't seen people do it. Not in this space necessarily, but I mean, there's
brokers. It's the brokers.
Yeah, it's
those guys who do their structuring. They do that, and they love it, and they all do it all of the time. It's like that's where they get off on. I'd say geologists or people that actually want to kind of do some actual.
I've seen it happen with public companies that have kind of, because again, it's hard to kill a public company, but where a company has really just gone out of business and they've been delisted, but they're sitting there with all these shareholders, and so they're good looking from a shell perspective, and they've got all and so they will go in and do like a 100-to-1 consolidation or something, and you wind up getting rid of all of the extraneous shareholders that you don't need because they get rounded down to zero. But that's I think that's different than what you're talking about.
Yeah, no, that's stuff that's got a bit of hair on it. Like it's got some legacy issues, and there's always some stuff to tidy up. Like you can do a rollback. I guess one of the things you need to do, and get a bunch of the shareholders out. But you need to have the complete control of it. But I think those aren't necessarily much cheaper than starting out with.
I mean, the players we've seen come into the space in the last 10 years are generally, they're coming in with either a clean company, or a shell that's been cleaned up, up.
But it's more of what you described, which is kind of the companies which have struggled and got a lot of hair on them, and we're going to go again. I saw what was the company that tried to? There's a mining company, and they picked up a shell which which used to sell dog food. Who the hell was that? It was about 2 years ago. It was hilarious, and I think the shareholders quite rightly said, "You've got to be kidding me. This thing's got completely the wrong shareholder base sitting in it." Oh man, I wish I could remember. It's funny.
What happens though too is you lose your tax losses. You can't carry them forward if you change your business. So there's things like, there's all kinds of extraneous considerations on this stuff.
But your view on cheap paper on in terms of, like, say, financing negotiations.
Your brokers, we're always looking at the fees that we're paying the brokers, and it changes depending on how desperate the world is at that time. And we do create scenarios whereby it's hard to get out of. So, I've seen us go from paying brokers, a 5% cash and 5% in broker warrants that are priced the same as the unit warrants that are going out. Right. So if it's a unit on $1 share with $1.50 warrant, the broker warrants are set at $1.50. And I've seen in very desperate times, all of a sudden that moves to 7% cash and 7% in units. So the broker is actually getting paid in units of shares and warrants, the same as an investor. Which is outrageous. And then we see that the broker warrants are actually, instead of going out at the warrant price of $1.50, they're going out at the unit price of $1. So there's, it's always tough playing the game with the bankers because it's whatever the price of the day is. It's what you wind up paying them. And that can be getting outrageous if people aren't holding firm in certain situations, to not pay these outrageous amounts. Turns out how desperate they are.
I was, for me as a banker when in London, we could not believe the fees that Canadian brokers were charging. We were like, is it Christmas? Thank you very much. It was like 5 and 5, 6 and 6, 7 and 7. I said, so 5% equity and 5% warrants. We were like, this is great. We're heading to Canada because this is like, I think our deals are to be bigger, to be honest. So we were getting like 1%.
These are small. We're talking, this is because, let's face it, most of the resource companies on the venture are less than 100 million market cap, and if not less than 50. And so you're doing smaller deals, more desperate deals. And so, they were able to ratchet that up.
Well, we did a $100 million deal once. I think it was for Great Western Minerals, a Canadian, and there was 100 million, and we I think it was 5 and 5, and we're like, sweet Lord, this is insane, because this is no way we did enough work to justify that. And in fact,
in our business, it's even more frustrating because they're phoning up the same 5 people I could phone up directly.
Yeah, I know. And the worst thing, the other thing that they do, just to like kiss each other's asses and like make sure everyone's in on the cabal is working together, is a company goes to a broker and says, right, we're going to raise some money, and then they go and invite 3 other brokers because they want to share the love with each other on the street, and you got to end up with having 4 brokers. I'm like, what? And 3 of which you do nothing. So
or if you tell them, that you're thinking of doing a financing sometime in the next month or two, they'll immediately pick up the phone and start phoning everybody, so that at the end of the day they can say, well, no, that was my investor. I bought for you. No, okay.
It's clever, right? It's clever. Oh
real
my
clever.
God, the fun in the games. Well, look, we better wrap it up there. It's the weekend.
Yes,
We've got stuff to do. You have a flock to look after. I'm just going to keep running with that one. So, look, white collar. Yeah. Enjoy yourself, whatever you get up to. What are you getting up to? So you gonna do sunshine
well, the weather's getting nice, so there's a lot of gardening in our future. We're going to nothing extravagant. We're just going to visit our kids and do a little gardening. Nice. Yeah, should be a nice weekend.
That's the same as me.
There you go.
I've had a shocker this week. One of my gardeners has resigned.
Oh my Lord! How do you survive?
Yeah, well, I don't know. I'm about to find out. I have to get my hands dirty. Isn't that
your sympathy meter kind of falling off here?
Yeah, and it's awful. I feel I don't know, abandoned. Right, Chris, we'll love you and leave you, and we shall speak to you next week, and we'll finish the fourth out of this 4-part series, and hopefully it's given some food for thought for people.
And then
see you next week.
Very good. Ciao.
Bye.